Trading strategy is a set of rules that we set for ourselves as traders. So, as a trader, you have rules that guide you, that enable you to know the direction of the market, and at the same time know when to place a buy trade or a sell trade. And at the same time, it will also help you to know how to manage your trade, place your take profit and your stop loss. So in this tutorial, in this course, you are going to learn everything about trading strategy. You will learn the components or the element that make up a trading strategy. You will also see how to create a trading strategy. So let's continue. A trading strategy has four basic elements. There are four basic components that make up every trading strategy. The first element there is the market structure. So when you are building a trading strategy, you must uh, define how you determine the direction of the market. Okay, you also have entry. Now entry tells us when to actually place that trade. Okay, you want to buy, you want to sell. Where do you buy? Where do you sell? It's the entry rules or the entry uh, components of the trading strategy will tell you when to place that trade. Now we have the take profit and the stop loss. When you have placed a trade, when you have entered into a trading position, you need to set your take profit and your stop loss. And finally, you have the risk management, where you define what happens when a trade is going against you. Okay, so whenever you want to start creating a new strategy, the first thing you do is to define your market structure. Market structure, like we said in our previous classes, we said it is the direction of the market, the direction of price. When price is continuously moving in the upward direction, we say we are in the uptrend market structure. When price is constantly going down, we say we are in a downtrend market structure. So in trading strategy, we need to define how we determine market structure, because the way I determine my own market structure may be different from the way you determine your own market structure. It is all based on uh, the trading strategy or the rules we have created for ourselves. Okay, so you need to define your market structure, how you determine market structure or market direction or the trend of the market. So that's the first thing you do. So to do that, you must have had experience or knowledge about market structure. So when you have the knowledge about market structure, it will guide you on how to define your own market structure. So if you have not gone through the tutorial on market structure, kindly go back to the course playlist and then find the topic for market structure. All right, let's continue. After you must have determined your market structure, the next thing you need to set is your entry criteria. You need to know when to enter a trade, okay, when to place that buy trade or when to place that sell trade. Now depending on the strategy you are creating, some persons define entry criteria based on candlestick patterns, indicator signals, smart money concept, and a lot of concepts out there in forex trading. All right, so you need to know, you need to determine how you enter a trade. As we continue with this tutorial, we are going to see a trading strategy. I'm going to give you a sample of a trading strategy so you see how I define my own entry on that particular strategy. Take profit level is the price level where you intend to close your trade in profit. Now let's say you have placed a trade. Okay, maybe you placed a buy trade, and as a buy trade you make profit when the price is going up. Now as the price is going up you are making profit. So for you to define or for you to determine where you want to close your trade in profit, you need to set your take profit. So when you set take profit, as price is going in your favor, in your direction of trade, you are making profit. So you keep on making profit until it get to a point whereby you feel like your trading idea is no longer going to work out. At that particular level, you do what? You close your trade in profit. So that level is the take profit level. Now you also need to set your stop loss level. Stop loss level is the price level where you intend to close your trade in a small loss, so that you don't blow your account. Now sometimes when you place a trade, the trade doesn't go in your direction. Okay, and you know if the trade is not going in your direction, you are going to be losing money. For example, you placed a buy trade. When you place a buy trade, you are meant to make money when price is going up, but instead of price going up, price started going down. Have you seen it now? Price started going down, and as price is going down, you are losing money. So for you not to lose all your capital, for you not to lose all your money, you may decide to do what? Set a stop loss level, so that once price reach on that particular level, the your trade will close and you will just lose a small portion of your capital. So how you set your stop loss and your take profit all depends on your trading strategy. And like I said earlier, when we move over to my sample strategy, you are going to see how I define my own take profit and stop loss. Okay, so let's look at how to develop a trading strategy. I'm going to use this sample strategy to demonstrate how I applied all the elements of a trading strategy to develop this particular trading strategy. So the first thing I did here is to determine the structure. So the structure for this strategy is determined using the normal market structure, which is impulse pullback, impulse pullback. So the first thing I did is to do or to observe and to draw lines. Okay, draw three lines across the most recent impulse and the most recent pullback. If you look at the if you look at your screen, you will see the illustration there. So once you enter the market, what you are interested in finding right now is the most recent impulse and the most recent pullback. So once you get the most recent impulse and pullback, you are going to use a line to trace them out. When you trace them out, automatically, even if you are not sure of the trend, it will automatically show you the trend of that particular chart. So when you draw these three lines, you are going to get line A, line B and line C. Now line A and line C are the impulse moves, the most recent impulse moves, while line B is the most recent pullback in this particular chart. Remember, the first thing in a trading strategy is to determine structure. Now I have determined my own structure using impulse pullback, impulse, and I use lines to what, indicate them. When you use line to indicate them, it will be more visible and more obvious for you. Okay, so I can clearly see the line A, line B, and line C indicating impulse, pullback, and impulse. So still on structure, the next thing you need to do is to indicate your point of interest. When you must have determined market direction or market structure using line A, B, and C, you are going to indicate point of interest. Now the point of interest is the center of line C. So you are going to divide line C into two equal parts. So the middle of line C, which is line BC, is going to be your point of interest. That is the point where you are interested in taking a trade. So if you look at your screen right now, you can see that price has approached the point of interest. The candlestick is touching the point of interest. Price is touching the point of interest. Is an indication for entry, an indication for you to enter and place that trade. So without looking for any other, for this particular strategy, there is no extra confirmation. Is an aggressive strategy whereby you take your entry immediately the price is reaching your point of interest. So if the structure is a downtrend structure, that means you are looking out for a sell. Okay, so if it's a downtrend structure, once price reach the point of interest, you sell. But then if it is an uptrend structure, okay, so this is how uptrend structure is going to look like. You can see price touching the point of interest. So if it is an uptrend structure, you buy. If it's a downtrend, you sell. If it's an uptrend structure, you buy. You are taking this trade at the point of interest, which is the middle of line C, line BC. That's where you are taking this entry. To set your stop loss and take profit for a downtrend structure, you should place the stop loss above line B, few pips above line B. That's where you place your stop loss, and then you place your take profit below line C. Now the distance for the take profit should be 2 times bigger than that of the stop loss. The distance between the entry to the take profit should be 2 times bigger than the distance between the entry to the stop loss, because you are using a risk to reward ratio of 2:1 for this particular strategy. Same thing goes for the uptrend structure, the buy trade. So for an uptrend structure, for a buy trade, stop loss is below line B, few pips below line B, and then take profit is above line C, and the take profit should be 2 times bigger than what, the stop loss. Moving over to risk management. Risk management has to do with how you manage your capital, how you risk your capital for a trade, and it also covers what you do, your behavior, what you do whenever you are in a losing trade. So this is what you cover under risk management. Now for this particular course, I am not going to go deep into my advanced risk management structure. I am going to talk about my basic risk management structure. I will leave the advanced risk management structure for our premium classes, for our premium courses. So that's by the way. So for this particular strategy, for this particular tutorial, the risk management here is that we are not going to risk more than 2% of our trading capital. It means if I have $1,000 as my trading capital, I am not going to lose risk more than $20. If I have $100 as my trading capital, whenever I want to place a trade, I am not going to risk more than $2. So that's the risk management when it comes to the amount I am risking per trade. Now the question is, how do you calculate your lot size to suit this 2% or this 1% of your trading capital when you are about to place a trade? So for you to get this 2% of your capital accurately, you are going to use a position size calculator. So there are so many position size calculators out there. You just need to google position size calculator, you see a lot of them. So with the position size calculator, you will be able to calculate how much you are going to lose at your stop loss. That is the risk involved here, because you have a stop loss. So if price reaches your stop loss, how much are you going to lose? Now to know to get that right, to get that calculation right, you use position size calculator. Position size calculator will calculate and tell you, okay, if you want to risk $2, use 0.01 lot size. If you want to risk $20, use 0.2, based on the number of pips from your entry to your stop loss. And definitely the amount you are risking from your entry to your stop loss, okay, will determine the amount you are going to gain at your take profit. For example, if you are risking $10 from your entry to your stop loss, it means you are going to gain $20 at your take profit. The same thing goes with if you are risking $1,000 from your entry to your stop loss, it means you will gain $2,000 at your take profit, because the risk to reward ratio here is 2:1. The take profit is 2 times bigger than the stop loss. So if you are risking $10, for example, at your stop loss, you will gain $20 at your take profit. If you are risking $100, you will gain 200, and so on and so forth. So that is the risk management involved in this particular trading strategy. Alright guys, that takes us to the end of this tutorial. If you have any question, you can drop on the comment box below. If you have not subscribed, you can simply subscribe, and if you like this video, you can give us a thumbs up and share to your friends. All right, see you guys in the next episode.